This is the Time Is Now podcast, presented by IRG.
Hey everyone, welcome back to another The Time Is Now podcast. I'm Daniel, your host, and I'm here with the boss. Giovanna is going to be my co-host today, and we are talking to Cristina Ortiz about 1031 exchange and how can you save money on your real estate transaction.
That's right.
And also we have the master of closings here on our office, Paulina, that also is going to ask questions because she wants to learn a lot about 1031 exchange. So before we start, please introduce yourself to everybody that is listening to us, and what's your specialty?
Sure. Well, Daniel, thanks for having me. As I said before we started doing this live filming, that this is my first podcast, so bear with me.
You couldn't be in a better place.
Yes, you're in the right place. Thank you. So, yes, Daniel, thanks for inviting me. And my name's Cristina. I'm a real estate attorney based here in Miami, South Florida. And I do title mostly for residential and commercial transactions. Where the 1031 subject comes into play is when you're an investor and you're going to be either, selling to purchase another investment property, then you sell that investment property to purchase another one, you can avoid being subject to a capital gains tax. And so it's called 1031 because it's pursuant to the IRS code 1031. So you can start off there. You can Google it, look on the IRS code. Obviously, it's very technical, but that's what I guess determines how you can save money. But as we've discussed before, 1031 is really like a deferment of this, right?
It doesn't mean that you're never going to pay.
Exactly. I mean, it could happen in 30 years if
Eventually.
you just keep doing it over. But, if you do it 3 or 4 times within 5 years, at the end, somehow there's going to be a gain and you're going to be subject to the capital gains tax, which is, could be, it depends, but it's around 15% usually of the gain.
Of the gain.
Of the gain.
Mm-hmm. That's right.
And the gain includes all the expenses on the purchase, all the tax property that you paid,
It's the
everything.
appreciation in value, and how does an investor realize that? Is through a profit, right? So any
So all the
expenses, costs, those things, that's not a gain, that's not a profit. That came out of your pocket. So it'd be, let's just say you purchased an investment property. There's that base principal amount that you purchased it for. And then there's going to be follow-up investments, with improvements. Maybe you need to repair some things. And then when you sell it, all we're looking at is what did you purchase it for, and what did you invest in it? This is done through depreciation schedules with your CPA, and then what you are realizing as a profit. Okay, so let's just start there. It's by the 1031 code, and that's what it is. It does not apply to your primary residence where you would live, your residential primary residence.
Have to be an
This
investment
has to do with real property that is for trade or business, which for us basically it's investment. To make money.
Does land
Qualify?
is qualified for 1031 exchange?
Yes, if it has to have it's under this category of real property. That's a building, vacant land, a lot, a farm, even a townhouse, but it's for business or trade. It's for investment. That is all real property covered under the 1031.
So even residential, even though it is bought as an investment property, so it's producing income, it qualifies as an
Absolutely, because it's for investment. It's not your primary residence.
Exactly.
What 1031s don't apply to, just to make it easier to visualize, are stocks, bonds, those type of things. So I don't know what scenario that would be, but for example, if you wanted to see if 1031 applied to you by a gain that had to do with stock or a bond or something like that, it would not apply. It's only real property.
Okay.
real estate.
And then when we had discussed this before, you had mentioned that it also has to be a property that's like kind. Could you give us a little bit more details, please?
Yeah,
about-
so there's like strict interpretations of what that means, and then there is, if you do it properly from the beginning,
Yes.
you can any real property. That's the first point, right? Real property. So we just went through that. It's
Yes.
real estate. That is used for business or trade. What does that mean? Investment, making money. Okay, that all can be used as an interchangeable like-kind property. Okay, if you're selling your primary residence to then invest it into 2 rental properties, that is not covered by 1031 because you went from a primary residence where you were not making money off of it, even if maybe at some point you did make money off of it. It's your primary residence. Okay. That is how the IRS would critique this or criticize this or audit this if they were to audit this 1031 agreement that you have. Another thing that comes up with that is there's people who say, well, I have a vacation home and I put it on Airbnb sometimes,
Yes,
Going to be
right?
my question.
Exactly. Well, that is also one of those things that you will scrutinize under a reasonable scrutiny. What does that mean? You can't live there 6 months. There's no strict rule that says like you must not live in the property for 200 days out of the year. There is nothing like that. But there is a scrutiny, right? I mean, a seminar that I was on yesterday, an IRS representative was saying, 2 weeks. I mean, try not to use it for personal use or live in it for more than 2 weeks
Per
in
year?
a year.
For 2
Yeah.
weeks.
But
wow.
that's a recommendation on
Correct.
on
That's
the,
not a strict rule though.
because
So,
the strict rule is it cannot be your primary residence.
exactly. Even in this seminar, look
And
how
what is the definition
Exactly.
of primary residence?
where you live, where you claim homestead exemption maybe,
Okay.
where you live in at least half of the year, right? Because maybe people have two primary residences. They live out of the country for half of the year and come back for half. But it's personal use is also another good keyword to use for that. Are you using it for your personal use for the majority or half of the year?
Okay,
Okay.
because
Okay.
if he has a vacation home, as Giovanna pointed, but he doesn't rent it, he uses for his own vacation, and he doesn't make money on it, so that would be considered like a second primary
Yeah.
on that
Yeah.
on those terms.
Yes, you would have to prove that this is something that you were as a pattern or typically using for trade or business, right? Using it as your second home or even for your kids in college to crash in while they're at the University of Miami and you have a condo here and you live somewhere else and your kid is using that condo, that is not for trade or business. You're not making money off of that.
Okay.
So, and remember, someone who has an investment property usually has already tapped in their accountant or CPA to do accounting for this property. What's coming in, what's coming out, appreciation and depreciation. So you're gonna have some kind of paper trail for that. So if you're using it as a second home for even a family member, that's for personal use. There's no income being produced from that property. It's not going to qualify under 1031.
Even though it might have appreciation, it's
there's-
not your
you know-
intent to buy for that.
And you
reason.
can't show it either, right? Because you aren't
Yeah.
using it for trade or use. Now, if it's a scenario where maybe you got into a bad investment and the intention was to rent it for business or trade or to make money, but you can't sell it or you can't rent it, and there was no income coming in, at least you could establish the intention was, yes, this is for an investment property.
Okay. Yeah, but then you're not making money. You're not saving anything. Anyway.
Right.
So the like kind, then, it's more associated to the fact that you're using for investment than the kind of the property. Meaning, I bought a townhouse to rent. I'm making money. It's an investment property. I never lived there. It's rented 12 months out of the
So
year.
far, so good.
I sold it, and now I want to buy an office. Is that considered a like kind because it's investment, or is not like kind because one is residential and the other one is
No,
commercial?
hey, it's a real property and used for trade or business. That is a like kind exchange.
Okay.
Okay.
Yes.
So what if you want to buy the same amount of money that you're investing, but it's two properties instead of one?
You could do that.
Okay.
You could relinquish 3 to buy 1. You could relinquish 1 property to buy 4. It even goes across state lines. I've been involved in
Okay.
1031s where a woman was selling 2 Alabama properties to purchase 1 investment property here in South Florida.
Oh, we had a case,
It can be
somebody asked
done.
about that.
Yes.
Yes, we
Let-
have a
before.
client who was interested in doing something like that.
Let me make it a little bit harder on you.
Sure.
The investor is American, or for fiscal duties, he's American, as American taxpayer.
Correct. He has a tax ID number. He pays
He has-
taxes.
yes.
We're not talking about immigration status,
Exactly.
right?
The company that he uses to purchase the real estate is here, but the real estate is outside the U.S. And he sell it. Technically,
Okay.
he needs to pay capital gains here because he had a profit. Let's
On the
imagine
property that is out of the country?
Yes, he
Okay.
bought it for $100,000 and he sold it for $200,000. He made a profit. He needs to pay taxes, income taxes here, right? Or
Are you
capital gain.
asking or did
I'm
that
asking.
happen?
I'm asking. He has to pay capital gain taxes for everything that he makes money on because he's American.
What is that's a good question. Now, it goes deeper. The property that he sold out of the country, the
It's
proceeds,
own-
the
it's-
profit is going to go into his company, into his American company's account. It's going to be a realized profit on the books
Yeah, it is.
Yes.
So then,
He has to pay, right?
yes,
Yes.
the
Okay.
gains.
Can he apply for 1031 exchange being this property he sold out of the U.S.?
Well, is he going to invest
His-
it back
yeah,
into the U.S.?
let's say he's
Yes.
going to buy another property in the same country that he sold. Let's say he sold in Brazil, bought in Brazil, sold in Brazil, and he's buying another property there.
No, because this isn't a real estate law issue. This is more of a tax. This is a strict tax subject. Okay, and the IRS only applies to American either entities or individuals or
But
properties
this
or
is his
companies.
American entity.
But
But still,
the
but the property is
1031
not
has to
here.
do with real property, and the real property is not located in the U.S. So I could be
Yes.
wrong, but I am pretty sure that the interpretation would be that no,
That no.
because these are properties,
I agree.
two properties outside of the United States. Okay, so the 1031, an IRS 1031 instrument would not apply to something that is happening outside of the U.S. because it's not just profit. We're talking, the 1031 has multi prongs:
Yes.
real property and gains.
This
Now
is
we're-
a real property and is a gain.
but it's not
But
in
it's
the
not
US.
located in the US.
Yeah.
But the law doesn't say anything about it.
I bet you there's gonna be
I'm
yeah.
sure there is.
Because you need to pay, if you are an American taxpayer, you need to pay your taxes from
Yeah, but
whatever you make money
That's
in the world.
fine. But if you're gonna buy another property, international,
yeah.
then that's
Yeah,
why
yeah,
it will
that's-
not apply.
that's-
Unless you're gonna, I think it will apply only if you buy a property in the U.S.
Right. So because for example, think about it. Now we're gonna go into the timeline of how this works,
Exactly.
okay?
Yes.
So what's gonna happen is that when you enter into a contract to sell your investment property, where you're intending to purchase another investment property, we're gonna use your scenario of being out of the country. This contract is not a Florida contract. It's not a U.S. contract, okay?
Exactly.
But you're selling. You're gonna go to sell it. You have to enter into what is called a 1031 exchange agreement. It is an agreement where in writing through a qualified intermediary. What's a qualified intermediary?
Exactly.
It's not even a title company. It's not a lawyer. It's not me. It is a agency, a third party that has nothing to do with the transaction because what the IRS calls constructive realization of your proceeds. What is that? It might have never hit your bank account, but even if it went into my account or into your lawyer's account, that is a constructive realization of these proceeds. Okay.
Proceeds exist. If you
Right.
have it or not, is not.
Yeah. So what's in this 1031 exchange contract or agreement where you're putting in writing? Because if you're ever audited by the IRS, you need this official thing. It couldn't just been an email. It's an actual contract with a qualified intermediary. They usually charge around $900, let's just say $1,000, and it's a one-time payment. You put it in your closing statement out of your. So I think it's pretty reasonable, especially with all the work that they're doing.
Also? They do the closing
No,
also.
the title company does. So that's why I work
the agent
so well.
only is there to get the
To
mon-
hold the money.
the money.
To hold the money.
Correct.
That's it.
That's it. And obviously to prepare and the paperwork for the timeline.
tax,
Because it's their job to hold the funds and also make sure that we're complying with the 1031 IRS
Exactly.
code. A qualified intermediary for me is the expert on IRS code 1031.
Yes.
And that is what their function is. And that is why me as a title company, remember, I have money coming in and out of my trust account that has to do with this transaction. So I cannot be the qualified intermediary. So those proceeds have to go directly to the QI, what we call the qualified intermediary. That is why they have to be involved before the closing. And when I say before, it could be the morning of that
Okay.
you decide, oh my gosh, I totally didn't know about 1031. I didn't realize I couldn't put my proceeds with you, the title company. That morning, you prepare the title work with, the 1031 agreement with a qualified intermediary, and you're safe. You're good. But the funds are going to go directly to them. So in this 1031 agreement, you're going to have the property you're relinquishing. Let's just say in this scenario, it's this international property. It's not domestic. Then you have to list the potential properties that you're looking at, right? Because that's what it's called. There's RP, which is the relinquished property, and then you have the reinvestment property, the identified properties.
But you have certain days, if I'm not mistaken, right? To make
45
decide.
days from the date that you closed on the sale, the
Okay.
day of closing. So that day, let's just say it's today, we would have 45 days to, in writing, write a list. And the IRS has a limit on the number, because then that's not fair, right? We could just say a book of, look at all these properties I'm looking at, and
Yes.
you really didn't identify a property. So you have to have a a substantial list where you show that, how did you identify them? Well, you identify them per location, the estimated capital.
Do you have to have under contract or LOI for them or something like that?
No.
You
just
need to point
identify.
out.
These are the ones I'm looking at, and you're telling a story. With when you're preparing your taxes, you're telling a story. So thankfully, there's no like strict identification rules on that. But the strict rules are 45 days to identify the property. And I'm still using your scenario where see how it doesn't make sense that we're using 2 international properties, but we're using a U.S.
Yeah, it doesn't make sense.
Right. So that's why I don't think it would apply.
But my question is still not fully responded, because right now we are trying to interpret it ourselves.
Exactly.
But if the law doesn't say anything,
then you
are
have
a
a
lawyer.
creative CPA. If you have a creative, just like when we do our taxes every year, you can get creative.
If it's not said, you can do it.
You have to tell a story, right?
Exactly.
That is why. If you know that you're reaching, when I call it reaching, like when you're like, the law didn't really speak, then try to be as specific as possible in telling your story through the 1031 agreement and with your CPA.
Yeah.
You understand?
Yes.
So the reason I am so involved with 1031s is, and I'm not a tax professional, I'm not a CPA, is because I have to be identifying these issues as a title attorney. I have to identify what's the purpose of this closing, what does my client want to do with these proceeds, etc. So that's where I pull in a qualified intermediary. So the 45 days is from the day that we close. We have to show a list or produce a list in writing, not even to the IRS yet. You're just doing it to your QI, to your qualified intermediary.
So you don't have to have the property yet. You just have to identify within the property that you're looking for.
Correct.
Not select the property yet.
Exactly.
And how many options did you say? Or not?
That the IRS is very specific on.
Yes.
Okay, and we could look that up now. I don't know if you want to take a look, but you Google it or something on our phones right now, because there is a specific amount. Like I said, they don't want investors taking advantage and just choosing a random, printing out the MLS and just being like, oh, here are my potential properties. No, there's an intentional decision that these are potential reinvestment properties. So that's the 45-day timeline, and then really the whole timeline is 180. So from the day that you close on the sale of your investment property, which is called the relinquished property, then within those 180 days, you have to close, not identify, but close on the purchase, whether it's 1 or 2 properties, whatever you're going to do for real property, it's 180 days. Yesterday, the seminar that I attended was really good. It was by the qualified intermediary that I use. It's affiliated with my underwriter. I'm an attorney and I do title, so I insure through the attorney's title fund, and we underwrite through the insurance company Old Republic. Old Republic is the biggest and oldest title company, not only in Florida, but in the country. They have their own intermediary. So it's awesome. That's how I have these resources. The purpose of this seminar was, have these rules changed? Has these timelines changed because of COVID and people getting sick and not traveling? They haven't yet. No. 45 and 180. You can't say like, oh, we were going to close, but it got delayed because of a COVID situation.
Yes, no.
They're not looking at it like that.
Just to be super clear, both the 45 and the 180 are from the day of selling the first property. It's not 45 plus 180.
Oh, no.
45 and 180 from the day
yeah.
you close the sale of your first property.
And that's important, right? Because let's just say you identify the property on the 100th day, you already missed that 45-day timeline.
Yeah, no. The 45 days is pretty clear.
Yeah.
The confusion sometimes may happen on the 100. Oh, so after the 45, I have another 100. But no. From the day you sold the property and close it, you have 45 to identify and 180 to close another one.
Yeah, and it's so technical, right? Because what I have seen, and I actually think it's a good thing, is what if you identified 6 properties within those 45 days? You're still within the rules, right? The code. But you end up closing on a property that was not on that list. That's okay too, because we know things don't work out, or you do an inspection and something falls through. So you just have to have like the good faith showing that you intended and you identified these properties, and you comply with the rules.
As you said, tell a story.
Correct.
Yeah, they're just layers so the IRS sees that you are actually looking for something to reinvest.
Yeah, like every year when we do even our individual taxes, right? We have to tell certain stories with things that we want as exemptions or something, It's the same thing.
Okay, now we have this case, I just remember. He's selling this property, which is a rental property, and he's buying a business. Okay, in this case, will that qualify?
Business
Is
not
there a real
problem.
property involved?
It's not a real problem.
No.
I mean, it's a lease. It's not because it's a business.
No. Because it's real property. He's selling a real property to buy a business, and that is, even though a business has assets and maybe inventory or whatnot, it's not real property. It's not land, a building, a lot.
No. There you
Okay,
go.
and the business has no real estate.
No.
That's what I just
Attached.
asked.
It's a
Because
lease.
if I'm the CPA,
Because if he
I'm
had,
saying
If he had, it would be the
we gotta
problem.
get
It
creative
will be
here.
a lease, so that's
if he
not.
had a real
A purchase, he
property,
owns
you
it.
could separate, and you use the proceeds to buy
Exactly.
part the real, and you wouldn't
Exactly.
pay there and the other one.
And
you
remember,
buy the
that's
business.
your, if you are going to be an investor, even if, the word investor, so everyone uses it now, but you're going to buy a property that you are intending to use it for investment. You know that eventually, at some point, you're going to sell it. Well, get a CPA that is well versed in the IRS code 1031, because in that aspect, if I'm that client, I'm telling my CPA, hey, we're buying a business. I am buying real estate within the business. You know, maybe it's it's part of the deal. Get creative, CPA, and get me that 1031 exchange
You could
coverage.
separate what is the,
Separate what's part of
Exactly.
the business.
And I have two questions.
Sure.
So one, if I'm guessing that maybe some people have this question, is there a minimum amount that the real property has to be worth? For example, can it be as little as $20,000, $50,000 of land?
Yes, absolutely. Remember, it's the gain. We're not talking, I don't even want to get into it, but we're not talking about FERPTA. That has to do with like the whole contract price.
Yes.
1031, you're deferring paying taxes on the profit, just the profit. So if your profit was $10,000, you're gonna have to pay a capital gain on that, right? It's not protected by any personal homestead exemptions or anything like that, right? So there's a capital gain. Those $10,000 you could reinvest into another real property, and it's covered.
Okay. And the second question, for example, after closing, the funds from the first day of closing to the 180 days, let's say that you close on the 179th day, the funds are kept in
The QI's
the
account.
QI's account.
And then that's why the QI's job even surpasses my job, right? Because on the day of closing, I've just the
You
the
disperse.
funds went to the QI, the proceed, what we call the proceeds or the realized profit, right? And then that QI is kind of on the hook for the next 180 days, saying, okay, client, we got to find your reinvestment property and we got to close on it. And then on the day of closing, just like all the other, there'll be a cash to close, let's just say, right? That QI wires your funds from the sale to the title company that's doing the purchase of your new investment property.
Okay.
Yeah.
yeah, the owner cannot touch the money.
No.
The owner
Never.
cannot touch the money.
Touch, and remember, it's called constructive realization. Like if your money, you're my client and you're the seller, and it went into my
It's like still
account,
yours.
you still sort of realize that profit already.
Yeah.
Exactly.
I don't think
Needs-
that's fair, but hey, that's what the IRS
Yeah,
says.
because the IRS
You're
wants
still
to know
not
that.
touching it,
exactly.
but yeah.
I'm not touching, but it's not the
Still.
qualified agent.
Correct.
That's the key player on this deal
Yeah.
is the qualified agent.
Exactly. And, let's just, of course, we're all subject to IRS codes that may seem unfair or don't make sense, but at least the QI that you choose, and hopefully they're a legit company, because another thing that we were talking about is that people, third parties, set up a business as an intermediary and they just hold your funds, but they don't really know about the timelines. They don't know about they don't have to be an accountant, but they don't know about 1031s. And they're just setting up companies and they have a trust account and they just hold the funds. So try to use obviously a qualified intermediary that is has a good reputation and has been doing it for a long time. I think their fee is reasonable, to handle this. It's not like...
So what does it take to be a qualified intermediary? Like you need to be registered in some kind of association?
Correct. You have to be registered and you have to be...
registered on the IRS?
Well, not technically. You just have to have a fiduciary. You have to be...
Okay.
You have to hold yourself out to the public as a fiduciary agent. Someone who
Doesn't have to be a CPA or...
No. They don't have to be a lawyer.
They don't even have to be a lawyer.
No, but they usually are, right? They're usually backed by attorneys or by accountants. There are attorneys who have become qualified intermediaries, but for the specific transaction,
They cannot do the
They
closing.
can't do the closing. They can't even represent any of the parties. They are just an
Just the
escrow
third
agent,
party.
basically,
Okay.
like a trust agent, a trust account agent. That's it.
So just remembering, we have 45 days to identify a property. We have 180 180 days to
close.
close it. It needs to be investment property, and the investment issue is, or the qualification of investment is the like kind. It doesn't need to be office and office, townhouse and townhouse. It just
Nope.
need to be.
We're talking
estate.
about
Real property.
real
That's
property,
it.
business or trade. That's, I think, the easiest way
Right.
To, okay.
Yeah.
Construction.
Uh-huh.
How does it work? I sold a property, and now I'm buying a land to build something that I'm going to eventually use as investment, either to sell it with a gain or to rent it.
So this was something that we discussed yesterday, especially in South Florida, because we do have a lot of,
Fix and
old
flips
fix and
and-
flips and stuff like that, right? So there are 4 methods of exchanging. We could go through all 4 of them, but there's the last one that we discussed was the construction exchange. It's actually called the improvement exchange too. So it's construction or improvement, and it defines it as you sell the relinquished property. We know what that is. It's the original one. You sell it, and you use the exchange funds, the proceeds. You use that to construct the improvements or whatnot to then purchase it. So even people who are using it to build the investment property, that is covered.
But
Okay.
it needs to respect the same rule of the money needs to be on the qualified agent at all
How do
times.
you-
So it doesn't say this. Look, it says upon completion of the improvements, the relinquished property proceeds. Then that's when it's realized.
Okay, so
it
basically
says
the
upon-
funds are going to be held in that third party till the property is finished.
But if I'm the investor who just sold my relinquished property and I have these funds with a QI, I'm saying, okay, QI, I need $50,000 for tomorrow because we need to redo the roof or something. I
Yeah,
don't know.
they need to
Then
send directly
correct.
to the contractor.
So-
They will.
They cannot send it to you to
Okay,
you pay
so
the
that's-
contractor.
because
They
Remember,
need to
use
pay
the
we're
directly.
setting
Okay.
setting the story, setting the paper trail. Okay.
Yeah.
Again, this definition does not show that there is, because 180 days for construction, we all know that could
Yeah,
be
that's too
impossible
short.
yeah,
sometimes.
exactly.
So the 180 is not
Depends.
here.
Depends.
And then, so just the 4 methods of exchange. We have the delayed exchange, where you sell the relinquished property, and within the 180 days thereafter, you complete the purchase. Okay, so that's actually, they're calling that a delayed exchange, but that's what we all know as a basic 1031 exchange. Because it's not happening on the day of closing or the day after. That would be something called a simultaneous exchange, where today in the morning I'm closing on selling my property, and I already could close on the reinvestment property, that afternoon or tomorrow. That would be a simultaneous one. And then we have the reverse exchange, which is where the purchase of the relinquished property occurs before the sale. So you are purchasing the property before you sell the property, where you're using those proceeds to purchase the other one. So I know that sounds a little convoluted, but there's certain investment structures where you have certain funds, you are purchasing it like cash, but then you can use those proceeds to apply it to this one, and your capital
To
gains
recover.
will be exempt from the capital gains tax. Okay, and then you have that last one, the construction or improvement exchange, which is what we were talking about telling the story of how those proceeds are going to be used. You can never realize those proceeds. Technically, you would think that by you telling your QI, hey, why are these funds for the construction or improvement of my investment property that I bought, you're realizing it, but that's an exception of a 1031. It will apply there because you're using it for business or trade on real property.
There's another rule on the 1031 that is very important, that needs to be the same entity that is buying and selling. You cannot assign to another person or another
Right.
company,
Yes.
correct?
Yes, that's true.
What happens? What happens? Okay, Daniel did it for 30 years. Not Daniel, John.
Okay. So an
John,
individual.
John dies. And this property is going to pass to his son. Who is going to pay the taxes? What's
The
going to
son.
happen?
The estate
Oh.
of John.
Okay. So that's
Yeah.
going to be calculated for backwards on the last 30 years, the amount of money that he didn't pay. And on that
No,
moment,
no,
No,
it's just in the
the-
last transaction. No?
It's the gain, right? It's just it's just the profit. So
yeah, it's just a
if he
profit.
sells it, so for example, John passes and his son is now going to sell this property, there's going to be a gain. And remember, the son did not buy the property or use his own funds.
Yeah.
I mean, every case is different, but
Yeah,
right?
but that's the question. Daniel started with $100,000. Throughout 30 years, now he has $1 million. John has $1 million.
It's not a million minus 100, and all that's subject to capital gains. That's why you have a CPA involved to does depreciation schedules and what you invested over the years and things like that.
Okay, but the difference is capital gains. Let's say
Yes,
not
yes.
900, but it's 500.
Yes.
Remember, the first step too is getting your CPA
So-
to say like, what is your profit here?
So after John dies, and now his son John Jr. has the property. Now on that moment, the capital gain from the past that John didn't pay needs to be paid on that moment.
When he sells the
It doesn't have a sale because he died and he's passing his
Like
property.
he inherited the
No.
property.
Inherited the
no,
property. Who's going to pay for that?
but that is not called a capital gain though. That's just like a profit that
Yes.
you're bringing a whole other subject
Yeah,
here,
I know
which
that
is
I know
the estate tax.
I know the capital gain is going to be realized when someone sells the property, but
You're saying
based
as
on the
junior-
based on the 1031 exchange rules, where you can only apply that to the same entity. Now it's John Jr. who is selling the property.
But John,
So John Jr. is going to pay only for the moment that he had the property for the capital gains, or for the whole period that John Sr. didn't pay for.
when
For the full gain. Basically, if he's acquiring the property for the certain amount, he didn't purchase that property. So whatever the gain is based on that sale is what he's going to pay taxes on.
His gain. So wherever the IRS didn't collect for the last 30 years that John Sr. was doing, is never going to get paid. That's my
in that
question.
case,
That's my question.
That's a good question. And in that case, 1031 wouldn't come into play because now we are talking about
Exactly.
something that you inherited. And when you inherit something, that's a whole other
A different
tax.
type of tax.
You can't get
I
like
under-
double and triple tax. You can't have a capital gain tax and an income tax and on this
Yes,
property
I
that you
understand.
inherited.
My ultimate question is, for the last 30 years, John Sr. was applying for the 1031 exchange and never paid for the capital gains because he was applying for the 1031 exchange.
Did he hold this one?
Yes,
He held this one property.
yes,
So he never
we-
applied for 1031 actually.
No,
Not applied, but
No, let's say he
never.
did.
no.
No.
He bought it,
He
he sold
buys-
it, he bought it, he sold it, he bought it, he sold it during 30 years.
Mm-hmm.
He bought it and sold it, I don't know, 10 properties. I don't care.
Right. The
he
10th
never-
property is the only
That one that
property
qualifies.
that is going to be considered as a realized income or realized profit
Yeah.
for
But
the
that-
junior.
for the junior.
So Junior is going to pay for it.
No, but doesn't pay for. He just pays for the gain.
Yes, I
he's
understand.
realized, but you're asking about the last 30 years, but the last 30 years wouldn't apply to John Jr.
Exactly.
John Jr. is
So
only dealing with
once
the last property.
John dies, it
I
dies
know.
with him.
That's what I'm asking. So all those taxes that were deferred, who's going to pay in the end?
You are on, okay. You don't pay a capital gains tax on all of the gains over the last 30. You're only doing it on the last property that you're selling. You're cashing in a property, right? You're not going to reinvest it. Well, the
That's what
gain
you-
from
that's-
that transaction. So if
that's
John
what you pay.
Sr. purchased a property in
Only on the last
2018,
one.
Yes.
in 2018, okay, John Sr. using capital gains from another investment purchased a investment property in 2018, and he died in 2020. Between 2018 and 2020, what was the realized profit?
Like it doesn't accumulate over time.
No, it's
No,
not like
no, no.
It's not
compounds.
like
That's
you
a
sold
great
it
idea.
at
No, that
2,000 and
Well,
you
then
owed
the 1031 wouldn't
5,000.
even
great
the
deal.
1031 wouldn't even exist because you're not how do I say you're not really gaining an advantage there. Then that's all compounding.
Of course you're gaining an advantage.
But you're not cashing it.
Now I have double advantage, because if I buy a property for 100, sell for 200, and I don't apply for the 1031 exchange and I need to pay taxes on it, I don't have 200 anymore to reinvest. I will have 180. I don't know. I'm just guessing. 180 to invest. So over the years, there I already have a very good what do you call a very good deal on the 1031 exchange, because I'm reinvesting the full amount of money. I'm not taking part of it and paying tax. So basically I'm reinvesting the taxes that I would pay if I didn't have applied for 1031 exchange. So what you're saying now is that not only I can reinvest the full amount of money that I'm making, I'm only going to pay taxes in the last transaction.
Once you
It doesn't matter.
cash.
It doesn't matter if I started with $100,000 in property and now I have $1 million. If I bought the last one for $1 million and sold for $1.2 million, I'm only going to pay capital gains on that too.
Yes.
If I'm the IRS and if I'm a QI, I am looking at this transaction of this
The
one
last
property that was purchased in 2018 and now is being sold in 2020, whether it was by John Sr. or John Jr., and they are not going to be reinvesting those proceeds into another one.
It's just
It's
the
the
capital.
gain from
That's the gain.
2018 to
Okay.
20. Yeah, that's it. Now,
That's the last
So
transaction.
everybody needs to do 1031 exchange if they are doing investment.
you don't have to.
You don't have.
You could take the proceeds because you need it
No,
to
no, I-
buy a car to give it to your kid to go to college. But
No.
you're going to pay taxes on the gain.
Yeah,
Yes.
but they have to because you save a lot of money.
Oh, okay. Yes, of course. But
But
I'm
you
just
never
saying.
cash
Save
it.
a lot, yeah.
You're never
Ideally.
cashing
You
it. So
save a lot
basically,
of
you're
money.
just reinvesting all the time. So basically, you're never
Yeah,
cashing them.
for
Yeah.
people that have part of their portfolio to real estate, they need to use 1031 exchange
Exactly.
because over the years they are going to save
But-
a lot of money.
Just going back, just to reiterate, it can't an inherited property or a property that was, I don't know, gifted to you from your parents, would that enter into the 1031 exchange or no? Because if your
needs to
parents
be the
bought it
same entity.
and then they
Yeah.
did a quitclaim deed under your name,
Mm-hmm.
right? Could that qualify
Once you sell the
as a
property-
1031 exchange if you did a quitclaim deed? Or is that
No.
So,
a little far-fetched?
But when you inherit property, even if you're not going to sell it and
You
you
have to.
inherited a value and the IRS looks at it as some kind of income. So just on that baseline, you are going to be subject to some kind of tax.
Mm-hmm.
Remember, a capital gain is when you sell something and you realize a profit. Okay, we're not talking about income tax or an estate tax. Capital gain has to do with when you are selling real property over and over again, and you're for trade or business.
But for example, I inherit the property or I'm given it to it by a family member, and then I sell that property and I want to reinvest that money. Can I use a 1031 exchange, or does that not apply because I didn't actually purchase the property?
You can, but remember, this is where the CPA comes in,
It's
and
all
we have
about-
to show, we have to do a paper trail of the how do I say depreciation and all that. Because what if you inherited a warehouse that your parents had for 50 years? I mean, it goes back to what he was saying. I mean, the whole time it was for business or trade. It's an investment property. They purchased it, 50 years ago, which is a completely different price and value from when you're gonna sell it. So there could be a significant gain there. Now, it's your CP, with investments and investment properties. That's when you put in all those schedules for where you calculate over the years, depreciation, everything that you or your parents have invested and spent on this property. So, there are ways to get creative with your CPA to see how you can set this up properly. Now, it's just my job to identify these issues and bring them up. But what you brought up reminded me also of, I've had where an LLC, where there are multiple members, not related. These are like business, like it's a business. And they created this company just for real estate. One guy wanted the money in his pocket, was okay paying the capital gain tax, and the other guy wanted to reinvest into another investment property to avoid the capital gains. Well, as part of their 1031 agreement with their QI, they had to set out, okay, the 50% ownership, let's just say it was two partners of a company, the 50% that the guy's keeping, that's his intention, but the 50% of the proceeds, right, of the profit, that the other partner wants to use to reinvest into a property, that's going to be the amount that is going to be considered exempt from the 1031. Not the two partners joint profit. It's just what you are reinvesting, and it can be separated. Again, you have to show the intention from when you're selling the joint property. That also comes in where, let's just say I make a great investment and I'm like, oh my gosh, I'm gonna make so much money off of this, and you want to take $100,000 in your pocket, personal, because I don't know, you want to buy a car, your kid's going to college, and you want to take it out to pay for their college, and then you still have money left over, and you reinvest that into a new property, a new business or trade, real property. You're only going to get taxed capital gains with what you kept in your pocket, so you could separate it.
Okay.
Yeah.
Going on that basis, if in the last transaction I have a loss, I didn't pay for taxes this whole time, and I won't pay in the last one because I had a loss. I bought for $1 million the last one, and I sold for $900,000. I have a loss. I don't have capital gains.
You haven't realized the profit. It's a loss. You don't owe anything.
I don't. That's
It's not clean cut. You know how the IRS is. I mean,
yes,
all
because
these,
that's
but
what
really
I'm
it's a
saying. I
loss.
didn't realize the gains on the last one, but if I started with $100,000 and now I have $900,000, I have a lot of gains. That's my question.
No, a loss is a loss, and you would have to show. You would
What-
show.
The 1031 basically overrules everything that you did in the past and only takes into account the last transaction.
Yes, because every time you do a new transaction, it's a new property.
Yeah, but doesn't make
That's-
sense to me how the IRS accepts the fact that I started investing $100,000. Now I have 900, but just because I lost $100,000 in the last transaction, I shouldn't pay taxes for the whole
Well,
period.
because you continue investing. That's why you haven't
Yeah, and
cashed the
you're
money.
still-
IRS is very cool.
Yeah,
You put it that way.
I feel like they trick you.
I'm making I'm making $800,000 in this example over 30 years, and I'm not paying a dime of taxes. They are cool.
Yes, but remember also what you're doing for what the grand idea is that if you are using a property for trade or business, you are creating a stimulation in the economy.
I understand.
Yeah. That's like, 3 years ago I was doing
That's the whole
I was
point,
I was
yeah.
teaching a bunch of seminars and stuff that
Like
had to do with the
property
1031
taxes.
and they had with Trump doing the opportunity zones. I don't know if you remember that. They were like, "Oh, it's gonna make 1031s obsolete. Everyone's just gonna be reinvesting money into these opportunity economic areas, and it's gonna facilitate economic growth and improve these like areas." But look, 1031s have stuck around because the IRS kept delaying their exact rules on what it means to be
An opportunity.
benefited or how are you going to benefit as an investor from these opportunity zones. So it kind of died down because it wasn't very clear, and if they want to change the rules, you could get screwed, for lack of a better word. So to me, the 1031 is an immediate solution if you don't want to pay capital gains tax right now or next year when you file your taxes. So you just reinvest it.
And if
And
you
wait.
have the clear intention to keep reinvesting that money that you are making. Yeah.
And what's cool is that, remember, you start small and you make a nice gain on one property. You can buy 2 more, and that's the point. It's for an investor. It's a tool to grow and grow and grow. But again, more money, more problems. Yes, more properties, more.
I want to have $1 million problems.
Yeah, exactly. Good problems is what people say. Those are good problems to have.
So what can go wrong? I mean, if you could do it this way, what can go wrong?
What could go wrong is if you didn't comply with
QI.
with the QI, and you try to get creative on your own. I've had that happen. I have investors that say intelligent investors, educated investors, but they didn't realize that before closing on the sale, they were like, "Okay, I made all this money on the sale. It's in my bank account. I haven't touched it though, so I'm gonna buy this other investment property." That's a 1031, and that's a big one. It could never have hit my account, the title company, or your account.
But
Even
what
if you didn't
about-
touch it, and even if you had it in a separate bank account, and you didn't commingle funds,
Okay.
you realized it.
The first step is to have the QI
That's the
in
first.
place. That's the first.
Just tell
thing.
somebody, tell your CPA, tell your title company, like, "Oh, hey, I'm thinking about doing a 1031. What should I do?" And that happens. Realtors experience.
Yeah, when you
with
list
this,
your property to sell, you
ask-
already have to have the.
yeah, the intention. You don't have to even know what property. Just know that it's a possibility. That's all. And then you could get, someone involved. Title companies, even non-lawyer title companies, know about 1031s, and they should put you down with a QI. That's the most important. There's pitfalls too with doing your own thing. Like, I sold it as an individual, and then I created this company, and then I purchased the business, but I don't understand. It's an investment.
So even though that you're the owner of the business, you're the sole proprietor of the business, and then you buy as a personal or a business, but you can change, even though that I'm the owner of the business, that doesn't count. You have to be the same entity.
Yeah, and what's good is that, remember, like LLCs and things like that, how they're set up. LLCs are like a pass-through company. So if you're the sole owner, and it went from like an individual, and now you're the sole owner of the LLC, you can create that story where it's still the same person.
You can create it, so
right?
that can be done.
Exactly.
Okay.
I can see a confusion happening because when we are drafting the contract, we need to put the name of the title company that is
The
doing
title
the closing.
company, yes.
So the confusion that I can see is when it's time to wire the money, the seller or the agent or whoever is dealing with that sends the title company's wire information instead of the QIs.
But
I
that's
think
why
that
that's
is
when you
very
identify it in the contract when it's a 1031 exchange, and that's that additional. Then the one you can clarify.
But
that
you still need to identify the the title company.
Okay.
On the-
In a perfect world, on the day that you sign your listing agreement to list your investment property, you already know it's going to be 1031. That's a perfect world, and you know to tell your realtor, and then the realtor knows to tell the title company, and the title company knows to tell the qualified intermediary. But that doesn't happen. So yes, the title company.
I see on some listings
Yes.
when we have like commercial properties mostly. They already specify on the
They already
broker's
specify.
remarks 1031 exchange because the seller is already saying that he's doing a 1031 exchange.
And that's in commercial real estate, where usually the person selling and buying commercial real estate is a little more educated,
Yeah.
experienced.
Yes.
They've probably been burnt in another transaction. That's
They
how people
already
always
made a
learn.
mistake. They already made a
That's how
mistake.
people always learn.
Like going back to what you were saying, but the buyer is who wires the funds, not the seller.
Yeah, but
So the
someone-
buyer sends the funds to the title company, and then the title company disperses to the QI directly,
Exactly.
not
Yeah.
to you.
Exactly,
So
not
you
you.
as a seller, you never receive
Oh, I
those
understand.
funds, so you don't have to
I
worry
understood
about
that
that.
the money needs to go to the QI, not to
But
the
no, but once the
escrow.
transaction is closed, because in the meantime the money's not yours yet.
Yes.
So here's how it looks like on the day of closing for the seller. On his HUD, right, if it's done right, on the HUD for the seller, there's going to be a portion of the proceeds that are, because, as a disbursement agent, the title company is maybe paying off
Yeah, I understand.
your
You said-
mortgage, your whatever, stuff that you have on your property, and then the portion after you pay all of your debts and mortgages on your
Instead
on your
of
property.
sending the seller goes to the QI.
And let's just say you're realizing $45,000. Those $45,000, it says it's being dispersed to whatever qualified intermediary. So the title company knows
Yes.
the 45 grand is going to this qualified intermediary.
Okay.
Yeah.
Um,
So that's
what happens
those are the
if
pitfalls.
what happens if the title company screws up and sends to the wrong account?
The title company screws up. Well, it's our job. It's the job
The
for the
insurance covers.
No. Actually, it's easier. It's the intention was there. The intention was to do the 1031. You did the 1031 agreement
Just
with the
recognize
QI.
the mistake
The
and-
QI gave their wire instructions, and the title company sent it to you, the seller, by accident, and you said, no, hello, look, I have
It's a
this,
1031.
I have the
So you
QI
send
here,
back.
and then you could wire. It's all
Yeah, that's why
showing the story and
Once you
acting in
can-
good faith.
Yeah. And we as
Explain it.
realtors
Yeah, but
always
it needs
help
to
our
be this-
clients read the HUD.
It needs to be the same day. You cannot realize that there was a mistake 2 months later.
Exactly.
Exactly.
Or
And-
45
Exactly.
days.
Exactly. You have to like.
And remember, the
identify
title
right away.
company would know or should know, like that beforehand, that there is a QI involved.
Exactly.
To be able to
Yeah.
qualify, you said what could go wrong? That's the biggest one I see, that people go through with the sale. They think that just having a different bank account, like me, the seller, I'm this investor. I have an account under just for my investment property account. And they think just having it there and that I didn't take out $1 means I could
Okay.
reinvest it and I'm covered. That is not.
No.
The biggest one is you need to have the QI. I say before closing, but even on the morning of, I've had a seller be like, "No, oh my gosh, I want to do the 1031." I say, "Absolutely not. We got to get a QI, and we add $900 to the HUD as the fee to pay the QI, and the QI does all the paperwork. I think it's very valuable to an investor.
It is.
So
$900 for not paying taxes forever.
Exactly.
I know that he thinks
And you have
IRS
to
is
look at it that
cool.
way.
Yeah, the IRS code is cool. Yeah.
Well, it's- if
Yeah.
you're not doing, you're losing a lot of money. You're
So
losing a lot of
something
money.
that I want to get back to you on is the for sure in writing from the IRS, or either IRS case law or case law through accountants, is the part about the international properties. Because the profit realized is domestic, but it has to do with properties outside. I think Giovanna and I are correct where it wouldn't apply, but I'm still going to look it up because this is a prestigious real estate firm that you guys have a bunch of international clients, and they're going to have
That's
those
our main-
questions,
And
and you
a
want
lot
to
of
have those
them.
answers for your clients.
Of
So.
course, you have 3 weeks to get back. with
Oh,
this
you
when
have,
this-
so you have a real.
when this
okay.
is going to be live, we do another outro for our
follow-up.
video.
I think that'd be a
follow-up,
great
and
idea.
Yes.
It would. And then I'm
So
also
everybody
gonna
that is
send
watching
you,
live
yeah.
needs to follow us.
You know
to
what I
get
would
that
love?
info.
weeks.
Can people leave comments? Because what would be awesome is if we had like an expert and they were actually answering our
I'm
questions.
sure they
Yeah,
are.
we
We
can-
cannot read the comments because
Because
we
it's Stacy,
cannot
but we
see the
can-
phones. But I'm sure we have some
We can
comments
work
there
it. We can work it.
because we're live.
Yeah.
So, We just can't read them right now, but we'll read them after and we'll reply to them.
Idea. Start doing live and having live comments.
Yes, we're gonna have to do it later on.
We can have Ashley here, like reading the comments for us.
Exactly.
Very good.
Yes, yes.
A lot of
Very
Next
information.
good.
time, next week,
And
we'll have it
questions,
live.
Other than our own questions
Yes.
that we
Yes.
bring up here.
That's great. That's great.
Yeah.
Christina, thank you very much.
Thank you.
Thank you, Christina.
Thank you
It was
so
great
much.
to
It
was
have
fun.
you today. Yes, it's fun.
It's so
We're
fun
doing
talking
this
about
every
taxes.
Friday,
Well,
The IRS is so cool.
When we were talking about not paying taxes is good. Not for paying them. Guys,
course.
thank you very much. Thank you, Joe.
Thank you
Paulina.
again. Thank you,
Thank
Daniel,
you.
for hosting this again.
Thank you, Daniel. and
We'll see you
Giovanna,
guys
Christina.
next week.
Yeah, so this is every Friday, right?
Every
Friday.
Friday.
Perfect.
The Time Is Now podcast by RG.
Thank you.
This is the Time Is Now podcast, presented by IRG.